This is the Nedgroup Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you. I'm joined today by Iain Power, CIO and Portfolio Manager of the Nedgroup Investments Balanced Fund. Thank you very much for joining us today.
Hi Rob, thanks.
So Iain, we've been on the road talking to clients this week, and you have a view on the SA economy and the challenges that we're facing and perhaps maybe some of the opportunities that are available.
Rob, that's right. I think from a South African perspective, I think everyone is aware that we are in a tough spot. We've had difficult economic conditions now for quite a few years, and I think the expectation of a recovery driven by reforms, structural reforms, is probably some way off, given the speed and decisiveness at which government is moving in that direction. So I think that, together with load shedding, with all the other, handcuffs, a lot of them self-imposed, that we've got on the economy, makes it difficult to get a rosy outlook for the SA economy. Now, that's, the backdrop. But having said that, you've got a lot of domestic companies now whose share prices have come under a lot of pressure, and you've seen quite big price declines across various sectors. And one of the sectors that we actually quite like, where we think a lot of the bad news is priced into these shares, is in the financials, but specifically the banks. Not all the banks. We think that you've still got to you've got to stock pick, and you've got to understand, which are the better franchises, which businesses we think will be able to weather the storm and grow, notwithstanding these tough economic conditions. But we're thinking on sort of between 6 and 9 times forward multiples, with dividend yields between 6 and 9.5% in Absa's case. You're starting to see some pretty reasonable value emerge in the financials.
But do you need an economic turnaround for them to start to perform?
So I think that's an interesting point, is that when we look at businesses, we try and look at them from a normalized perspective. So in other words, we understand where we are right now in terms of the economic cycle, but we'll try and price those assets based on what we think their normalized returns look like on a through the cycle basis. So right now, it's probably fair to say that South African stocks, some of them are certainly under earning relative to their future potential. But we're also cognizant of the fact that this difficult economic environment is probably unlikely to change over the next 2 years. So it's going to be tough. So what we're looking for is businesses that can grow irrespective of the cycle. And when you look at some of these banks, they are actually valued at levels which are pricing in negative real earnings growth. In other words, when your dividend in Absa's case is 9.5%, you don't need much earnings growth to get you to a double-digit return. And in the context of inflation at sort of 4.5-5% odd, if you can get a 10-11% return, we think that that's pretty compelling. So, notwithstanding, tough economic conditions, your dividend yields are already giving you 6 to 9%. And if we can generate another 2-3% earnings growth, well, then that's how you can get a 10% return. So I think from a truffle point of view, we wouldn't be generically positive on the entire South African SA Inc. space, but we think a lot of the bad news is now starting to be priced into certain shares and certain sectors. And the one that, as I said, that we're interested in is some of the banks.
You talked this week about tail risks around the world and how that might affect global growth, the global economy, but also have a knock-on impact to SA as well. So what are those tail risks?
No, that's right. And I think these risks and shocks seem to come at the least opportune times. And South Africa, as we've just discussed, is in quite a difficult spot. And now on top of this, there is fears around potential global recession as a consequence of the coronavirus. And then on top of it, we wake up on 2 days ago and we've got an oil price war. So I think the long and short of it is emerging markets, and South Africa, no different to a lot of the other emerging markets, is a very open economy, and we are effectively a flywheel on global growth. So if global growth slows, emerging markets slow much faster, and you get that knock-on into our economies because exports and trade is such a bigger percentage of our underlying economic growth. So if you compare, generally emerging markets to, for example, the United States, where 70% of the economy is driven by consumption, and it's an inwardly focused economy, we are much more exposed. So I think the risks now of these exogenous shocks coming at this particular time makes us even more vulnerable to, I guess, global uncertainties, which we have very little control of. So, once again, highlighting the fact that when we're allocating capital and we're looking for assets, margin of safety, and making sure that we're buying into the intrinsic values that we are looking at, but you need a big discount. You need a much bigger discount because of these uncertainties.
And you've got a fair bit of cash, bonds, dry powder, if you like, to put to work. And you touched on attractive valuations coming to bear, not just in SA, but around the world after this week. Have you been using any of that dry powder recently?
So that's exactly the point, is that, when asset prices are looking full, as they were in the beginning of the year, before a lot of these shocks and factors reverberated around the world, we were sitting on quite a lot of dry powder, quite a lot of cash in the portfolios, really waiting for volatility and anticipating better entry levels in asset prices. So global equities have now, and certainly the US, has come back closer to what would probably be maybe slightly above fair value, but they're not cheap yet. Having said that, on a stock-specific basis, what happens is when you get a sell-off and the market goes down 15, 20 odd %, you get a lot of good companies that are sold off with the bad companies. And therein lies the opportunity to then start to allocate capital into assets which you can now buy 20, 30% cheaper than you could 3-4 weeks ago. And obviously the opportunity then is that your prospective returns now, paying a much cheaper price, look so much more attractive. So that's exactly what we're doing. We are looking at a lot of the businesses that we like, and we have entry points or entry prices that we would be prepared to pay. And as these stocks get to those ranges, we will look to deploy quite a lot of our liquid assets back into the market.
And one area that you were invested last year and served you quite well was the platinum group metals, or companies linked to those prices, the PGMs. They've done very well. Are you still holding them? Have you taken your profits there?
So we are still holding, but we did take profits. We did reduce our positions. Just the bet size or the position size had grown to the extent that those share prices had obviously done well. So just to illustrate, we were buying Impala Platinum at around about 20 Rand a share. The share price went all the way up to about 165, 170 Rand a share. So, if you've had, 1-2 odd % of the fund's capital invested, that's grown by, a factor of 7 times. So we have taken quite a bit of profit, put that money in the bank, but we still sit with a baseline position in these stocks because the underlying free cash flow positions in the shares look pretty attractive. We also believe that the supply response that you would normally get from companies when prices of the underlying commodities are high is unlikely to manifest. And the reason for that is quite simply all the producers, and particularly the producers in South Africa, are not particularly confident about the future in terms of their ability to get electricity, if you are starting a platinum mine, to get water. And more importantly, with the advent of electric vehicles and the likelihood that as global auto manufacturers put more focus on EVs, we're likely to see electric vehicles take share from internal combustion engines over the next 20, 30 years. So if you are a platinum mine today thinking about a capital decision, which is going to take you 10 years, you're going to spend 25 billion rand to put in a deep level shaft, your first cash flow that comes from that project is in 10 years' time. So I think the uncertainty of those factors that I've mentioned is really putting management of these businesses on the back foot, saying they want to wait and see what develops. And despite higher prices, no one is prepared to pull the trigger on putting new capex to get ounces out of the ground. So I think
supply is constrained.
So supply is very, very constrained. And I think on top of that, last week we had Amplats, which announced that one of their concentrators, furnaces blew up because there was water ingress. And effectively what it means is that instead of producing 4.5 million ounces for this next coming year, they're going to be about 1 million ounces short. So this just adds further pressure on a market which is in short supply of final product.
So talking of low weightings in the portfolio, I understand that you don't hold any Sasol at this point in time. It must have been a relief given what happened on Monday. What's your view now? Is there a price that you will pay for Sasol?
So Sasol is a stock that we've been concerned with because of the balance sheet, and I think the tail risk insofar as, if you do get economic shocks, the probability of having some sort of capital event, which we now find ourselves in, is high. In other words, where they have to raise capital. So we've been pretty much underweight in all our portfolios, and I think the factor that we did not forecast is we didn't forecast, I guess, the Russians and the Saudis going into a full-blown price war. But what we did see, and there was evidence of this, is that chemical prices have been coming under pressure for quite some time. Oil prices were sort of slowly drifting down, which was putting more and more pressure on the Sasol balance sheet and increasing the probability that they would breach their covenants in terms of the underlying debt covenants. So when you have a business that has very high operational leverage, in other words, the fixed costs are very high, and that means that when you have changes in the underlying cash flows, particularly when you don't have control over the drivers of your cash flows. In other words, Sasol has no control over the rand, and they have no control over the oil price and chemical prices. But on top of that, when you've got a lot of financial leverage or debt, if that underlying profitability moves against you as a consequence of lower chemicals or oil prices, you can very quickly find yourself in a difficult position where you are unable to pay back your debt. And I think right now the market is absolutely now starting to think about the probability of a capital raise so that they can try and weather the storm.
Fantastic. Thanks very much for your views and for joining us today.
Thanks, Rob. Thanks for inviting me.
Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.